Turning now to corporate news, the deal may soon get sweeter. British chocolate maker Cadbury rejecting Kraft's $16.7 billion bid. That may lead to a joint competing offer for Cadbury from Nestl and Hershey, which could force Kraft to increase its bid. All of this may be a sign that Europe's frozen takeover market is starting to thaw after 5 years. Who will come out on top? Jeremy Batstone-Carr of Charles Stanley joins us now live from London. Good morning. And how likely is it that Nestl and Hershey will enter the fray and put in their own bids for Cadbury?
Hi, Scarlett. We take the view that it's not particularly likely that they will mount hostile approaches at this stage. Nestl have been making noises in Europe to the end that they aren't particularly interested at this moment in time in getting involved. And of course, for competition reasons, given that both are substantial players in the confectionery, particularly the chocolate segment, you wouldn't expect them to. Hershey may be limited, of course, by the company trust, which may act to preclude hostile corporate activity. However, one wouldn't necessarily want to rule them out of being involved in a potential breakup were Kraft to be encouraged to make a higher offer for Cadbury and ultimately win the day.
Okay, then let's focus on Kraft for a moment. Is pricing the main obstacle to Kraft getting a bid accepted, or does Cadbury not want to put itself up for sale right now?
Cadbury absolutely does not want to put itself up for sale. It's divested its US beverages operation. It's become more focused. The board has a very aggressive mid-teen margin target by 2011 in place, and there are indications in half-year results which came out at the end of July that that target is beginning to move in the right direction, or where they're moving towards that target appropriately. However, the fact that Cadbury do not want to be acquired does not necessarily mean that investors in Cadbury do not want Kraft to make a higher offer. So it may very well be that Kraft make an approach to shareholders, possibly at a higher price, in order to attain control that way.
Jeremy, according to Bloomberg data, Kraft's bid was about 13.1 times EBITDA. What would you say is a reasonable multiple for an acquisition?
That's a very good question. I don't think, given the absence of potential suitors elsewhere, that Kraft will have to pay a huge amount more. They've currently got 745 pence a share in cash and shares. The market wants about 830 to 850 pence, not the 900 or £10 a share that had been speculated on in the immediate aftermath of the approach. That would put the shares on a multiple of something like 13.5 times EV/EBITDA, but of course Kraft is envisaging something like $650 million worth of cost savings, which would bring that EV/EBITDA multiple down post-completion to about 8.5 or 9 times. So it would stack up. I therefore think that maybe another £1 a share, or maybe $1.50 a share, $150 a share, that could do it.
Okay, thank you so much. We'll look for that. Our thanks to Jeremy Batstone-Carr of Charles Stanley in London.